Definitely. I own gold, but I own silver too, and I recommend it. Silver is a little bit more difficult to analyze because, I mean, gold is not good for anything except money. So if you like money, have some gold. It's obviously a precious metal, but the industrial applications of gold are very few. Silver is different. Silver has a lot of industrial applications. So, but it is a precious metal. So you have to think of it as a precious metal money on the one hand and industrial input on the other. Those can be moving in different directions. Obviously, the precious metal aspect is driving silver higher, but as we get into what looks more and more like an industrial recession, that could be a drag on silver use. But let's focus on the precious metal side.
Gold just shattered another record, blasting past $3,800 an ounce as investors brace for a weakening dollar, Fed rate cuts, and political chaos in Washington. Silver is on the move too, touching multi-year highs with demand soaring from both industry and safe haven buyers. But here's the urgent truth. Jim Rickards says every American must own silver right now. Why? Because silver's unique role as both money and industrial metal makes it the lifeline asset when confidence in paper currencies collapses. If you think it's too late, think again. The real move hasn't even started.
A couple of things about silver. Number one, it tends to lag gold. There's no way that gold's going to the levels I'm talking about and silver is not going to go to $100 an ounce. If you see $20,000 gold, you're going to see $100 silver or more. But silver tends to lag a little bit. The gold takeoff happens and it makes all the headlines and people get spun up. And then silver just kind of sitting there like, what's wrong with silver? And then all of a sudden, silver starts to move. So I think you're exactly right, Jesse. We're in that mode right now, but it plays catch up. So silver could actually go up faster because it took longer to take off. So I think the way you described it is exactly right. But silver has a very important monetary use that I would say makes it even a little bit easier than gold, which is it's more practical. If you had a crisis and you had, where people lost confidence in money or, an electric grid breakdown and we had to kind of use gold and silver to feed our families, so to speak, silver is a lot more practical because if you have a 1 ounce gold coin, let's say, okay, that's valuable. It's a form of money. It's bullion. But if it's worth $4,000 or $5,000, as we're describing, that's an awful lot of groceries. If you want to go out and get food for your family, a silver ounce or 5 silver ounces, which today would be $200, that's about the right amount of money to go shopping, in other words. So I recommend people have what's called a monster box. A monster box comes from the U.S. Treasury. It's the U.S. Mint, but of course the U.S. Mint is regulated by the U.S. Treasury. It's Treasury green, has a compression strap in it. Inside, in sleeves, plastic containers, are 500 1-ounce American silver eagles. They're pure silver, no alloy, beautiful design. But the point is, with 500 of them, that could be walking around money, as we say in Philadelphia. That could be spending money to feed your family, whereas gold will preserve value. By all means, have gold, very valuable form of property, but gold could almost be too expensive in terms of trying to spend it on the street. But silver, when I was a kid, even a young adult, we had silver dollars were common, at least be on your 21st birthday. Some aunt or uncle would give you 21 silver dollars, cost $21. Today that would be $800 worth of silver or more. As silver's taking off, it's lagging gold, but it's going to catch up. It's going to do very well. And it's also a very practical metal to have for basically spending purposes. Yeah, obviously gold's been going up. It's up well over 200%, more like 250%, just in recent months. And, you go back over longer time frames, it's a lot higher than that. We're in a major gold bull market. The point I make is that this is going to continue. And a lot of investors ask me, say, well, hey, Jim, you said buy gold when it was 1,500. It's, 3,700, kind of teasing around $3,800 an ounce right now. Did I miss the boat? And my answer is, well, you missed, $1,300 worth, but no, or sorry, $2,300 worth, but no, you did not miss the boat. This rally is really just getting started. There are 3 main drivers. The first one is central bank buying. Now, 2010 was the year of inflection, meaning from 1970 to 2010, central banks and finance ministries, basically official institutions, were net sellers of gold. Beginning in 2010, they became net buyers of gold. Now, different central banks involved, Switzerland, UK, Australia, Canada were all sellers, still are. The Swiss have stopped selling. Canada, I think, sold all their gold. Not saying I have a treasure chest, but I think I have more gold personally than the government of Canada. Those some of those countries are still sellers, or at least they've kind of dialed it down to zero. The buyers are new. They're Russia, China, India, Japan, believe it or not, Turkey, Iran. Iran's not transparent, but there's a whole set of buyers out there. Vietnam, for its size, is buying a lot of gold, and they continue to do so. Now, central banks, to be clear, they're very savvy buyers. They're not going to drive the market a lot higher by themselves, and they don't want to. If you were a buyer, why would you want the price to go up a lot? You'd say, "Hey, I'm still buying, so I just as soon keep it low for a period of time." But what they do is they put a floor under the market. They buy the dips. I hate to use cliches, but they do buy the dips. They put in standing orders. Russia for a long time was sort of 10 tons a month. Put in the orders with dealers in London. They don't want to disrupt the market, et cetera. But if you're an investor in gold, if you're any an individual, everyday American, or hedge fund, or whatever, and you're interested, you have limited downside because the central banks are putting in a floor, but unlimited upside for reasons we'll talk about. So that's what I call an asymmetric trade. It's a very nice trade. The second reason is, good old fashioned supply and demand. You learn in your first week of economics courses. Might be the only thing you learn that's really valuable the way they teach it these days. But global output has been flat around 4,000 metric tons per year. That's all the mining in the world for about 6 years. Now, I'm not saying peak gold. It hasn't gone down, but it hasn't gone up. Just a little bit around the edges, but not very much. Right around 4,000 metric tons a year. So if you have constant supply, which we have, and increasing demand, which we do, that means the price goes up. It's just, limited, flat supply, increasing demand, price goes up. It's pretty much that simple. The third factor is that people say, gold's an inflation hedge. It can be an inflation hedge. The correlation between gold and inflation is less strong than most people assume. But I call gold the everything hedge, meaning, will it hedge inflation? Yeah, it actually hedges deflation. People don't understand. During the Great Depression, the best performing stock on the New York Stock Exchange was Homestake Mining, which was one of the largest mines in the world at the time. That's actually the foundation of the Hearst fortune, going back to George Hearst in the late 19th century. But I visited that mine, it's out in Lead, South Dakota. It's an open pit mine and an underground mine. They're not producing now. They produced up until around the year 2000, but certainly in the 1930s, one of the largest gold mines in the world. That stock went up at a time when the Dow Jones Industrial Index fell 82%.
Jim Rickards makes a clear distinction between gold and silver. Gold's only role is monetary, a pure store of value. Silver, however, is both a precious metal and an industrial input. That duality can create short-term weakness during recessions, but ultimately it sets the stage for explosive gains once monetary panic takes hold. Silver tends to lag gold at first. Investors get excited about gold's breakout, wondering why silver isn't moving. Then, suddenly, silver plays catch-up, often outperforming gold on the way up. Rickards believes that if gold surges toward $20,000, silver breaking past $100 an ounce is inevitable. But Rickards also emphasizes silver's practical use in a crisis. Imagine a currency collapse, an extended power grid failure, or a scenario where the dollar loses credibility. A single 1-ounce gold coin worth $4,000 or more might be too valuable for basic purchases. Silver fills that gap. A few silver ounces, $40 or $50 each, could buy food, fuel, or medicine. That's why Rickards recommends Americans own a monster box of 500 1-ounce American Silver Eagles. It's the kind of walking around money that could keep a family alive in a breakdown. Meanwhile, gold is already in a historic bull run. Rickards highlights three unstoppable drivers. Central banks are buying. Since 2010, nations like China, Russia, India, and Turkey have become net buyers, putting a permanent floor under gold prices. Flat supply versus rising demand, global gold mining has been stuck at approximately 4,000 tons per year. Demand is rising while supply refuses to budge. Gold is the everything hedge. It protects against inflation, deflation, social unrest, wars, and financial collapse. In the Great Depression, when stocks crashed 82%, homestake mining stock and gold prices soared. Rickards also warns about anchoring bias. Investors fixate on $1,000 gold moves, but as prices rise, each $1,000 leap represents a smaller percentage gain, making the next leap easier. That psychology fuels frenzies. From today's $3,800 gold to Rickards' forecast of $23,000 may sound extreme, but once momentum builds, each leg higher comes faster. And when gold goes parabolic, silver doesn't just follow, it explodes. Recent events prove him right. Gold has just hit fresh records above $3,800, powered by safe haven flows and central bank demand. Silver is pressing higher as supply tightens and industrial use expands in solar panels, electronics, and medical tech. The gold-silver ratio remains historically stretched, pointing to massive silver outperformance ahead. Rickards' direct message is blunt: gold preserves wealth. Silver gives you liquidity and spending power when systems fail. Stack both, but don't delay.
From October 1929 to June 1932, which was the bottom, almost 3 years, the stock market fell over 80%, but homestake mining went up, and it was the best performing stock on the New York Stock Exchange. Gold itself went up 75% during the Great Depression. It went from $20.67 an ounce to $35 an ounce, which, measured in dollars, that's a 7% increase during the greatest sustained period of deflation in U.S. history. So the history of the Great Depression says when stocks are crashing and deflation takes over, gold goes up significantly. So it hedges that. It also hedges inflation because, again, as we saw in the late 1970s, in 1979, 1980, inflation was 13, 15%. U.S. Treasury notes were yielding, 10-year maturity was yielding 15%. You could have bought a 10-year Treasury note that would pay you 15% a year for the next 10 years. But from 1971 to January 1980, gold went up 2,100%. So it hedges deflation, it hedges inflation, it hedges social unrest, natural disasters, civil wars, regular wars, et cetera, and uncertainty in general. So it's very good in that sense. And one last point, Jesse, and kind of why I see this continuing and getting to much higher levels. There's a little bit of math. I mean, you can do calculus if you want, but I try to keep it around the fifth grade level because there's no need to be more complicated than that. There's a behavioral psychological phenomenon called anchoring. And anchoring just means, we're all humans. We all have biases, which are usually a good thing. It kind of kept us alive for a couple of million years. But an anchoring bias is you get a number in your head and it means something and you anchor on it and you kind of filter out other data around it. So people obviously who own gold look at price increases, and let's just take big chunks. $1,000. $1,000 an ounce is a lot, but we've been seeing it go up $100 an ounce every couple of days for the past month or so. But let's just take bigger chunks. Take $1,000. When you go from $2,000 an ounce to $3,000 an ounce, that's a 50% increase. When you go from $3,000 an ounce to $4,000 an ounce, that's a 33% increase. And when you go from $4,000 an ounce to $5,000 an ounce, that's a 25% increase. The point is, there's still $1,000 leaps. And if you have 50 ounces of gold and it goes up $1,000 an ounce, you just made $50,000. And people think of it that way. They focus on the $1,000, or in my example, the $50,000 gain, and they're like, ka-ching, ka-ching, that's great. But what they don't realize right away, because they just don't think about it, each one of those $1,000 gains is easier than the one before because it's the same $1,000 gain, but it's a smaller percentage gain because it's calculated off a higher base. So going from $9,000 to $10,000, that's only an 11% increase. I mean, 11% is kind of like a good month these days. So my point, and this is where you get into the frenzy stage. We're not there yet. We're getting closer, but all of a sudden it's going to go 8, 9, 10, 11, and those $1,000 chunks those $1,000 leaps are going to keep getting easier because they represent a smaller percentage. When you go from 20,000 to 21,000, that's only a 5% increase. Which is a good week. So that's one of the ways you get there from the perspective of $3,800 an ounce or $3,700 an ounce, where we are now. $23,000 seems like, I mean, that's the far side of the moon. But actually, as you get closer to it, it gets really easy to see that kind of spike. So yeah, that's my forecast. Those are the reasons behind it, and they're not changing. If anything, they're getting stronger.
This isn't speculation, it's preparation. Jim Rickards is warning Americans. Own silver now, before the window closes. Gold will protect your wealth, but silver may be the only usable money when everything else breaks down. Now let me ask you, do you think silver's real-world practicality makes it more valuable than gold in a collapse? If gold surges to $20,000, where do you see silver? $100, $200, or even higher? And the most important question, will you act now or wait until it's too late? If this breakdown gave you clarity, make sure to like this video, subscribe, and hit the notification bell so you don't miss the urgent updates ahead. The reset is already underway, and silver could be your lifeline when the system cracks.